markets at noon, and let's take the show ahead. And now we are joined by Nilesh Shetty, portfolio manager from Quantum Advisor, and with him we'll be focusing on his market strategies, and we'll also try and understand where is India placed as far as global peers are concerned. Nilesh, hi, afternoon, and welcome to the show. I just want to get a sense of the market right now, considering the valuations across market caps. First of all, what's your view in terms of valuations, and especially in small and mid caps? And also, how do you think the global headwinds, are you even considering them as headwinds that might impact our markets now? I'm talking about a time frame of a quarter to quarter months.
I mean, valuations are expensive in sort of simple language. I don't think there is enough for safety in terms of risk reward right now. Large caps are still better placed relative to small and mid caps. I mean, earnings have materially slowed down if you look at Q4 numbers and commentary coming from Q1 from corporates. And in that environment, markets are within touching distance of their all-time highs. And I think there could be earnings disappointment for a lot of corporates in the near term in terms of financial results that they report. So I think investors need to be careful. In terms of geopolitics, again, India remains relatively isolated with what is happening in West Asia and sort of Middle East, barring the second order effects of impact on crude oil prices, which India imports. But apart from that, it doesn't directly impact India. But of course, the tariff question and what India negotiates with Donald Trump, that will be keenly watched. But our sense is India is still relatively better placed to most other economies. I think we may be able to end up signing a better deal than other economies. But by and large, it may not have a material impact on valuations, but it may impact sentiments in the near term.
So, Nilesh, hi, this is Ankur this side, and I want to understand in this scenario where you explained that 9th July deadline is looming, there may not be much impact. But in this scenario, what should one do? Should one focus on large caps or also look at the opportunity in mid cap and small caps?
Yeah, mid caps and small caps remain very, very expensive. You might have stock specific opportunity there. But by and large, I expect that sector to not, or that segment to not do well over the next 12 to 18 months. The large caps are relatively better placed, and you still have large pockets of opportunity there for you to allocate to their portfolio. So at least our portfolio right now is heavily tilted towards larger cap names where we find much better safety in terms of valuations.
All right, let's talk about a time frame of 6 to 8 months, where I want your help in understanding how are you looking at the second half of this particular calendar year. If we talk about your focus on consumption, where exactly are you looking at in terms of what pockets, driving factors, which are going to be dominant in next 6 months, and how do you think in terms of themes as well, what is going to play out and what is out of flavor according to you now?
Yes, so our portfolio style is value. So our focus remains on valuations. So even though consumption per se may broadly pick up over the next sort of 6 to 8 months, and that is the hope. The stocks that we have is where we think there is significant margin of safety in terms of valuations. So we do have a significant allocation to the two-wheeler space, which we have in the portfolio. We added a consumer durable company which underperformed sort of over the last 2 years, but now we think offers a reasonable valuation, which we have in the portfolio. We continue to have large allocation in private sector banks where we think there is significant valuation comfort relative to their own 2-year history, which is a large part of the portfolio. We also have names in the insurance space in the portfolio where valuations have materially derated and where we think there is significant margin of safety. We continue to believe IT services offers reasonable valuation. They've missed the entire rally over the last sort of 12 months. And if there is any kind of uptick in consumer IT discretionary spend in the Western world, you will see these companies re-rate. And we think that is where investors should be allocated to. So that is sort of where we are allocated to. It is a mix of where we think fundamentals offer much better margin of safety in terms of valuations.
All right, thank you so much for that perspective and joining Nilesh on this show. With this, it's time to take a quick break, but don't go away. We'll bring you the important news of why SEBI's interim order was passed against Jane Street.